Okay, what I'd like to do, oh, I promised one more thing, and then I got to get to this master lease thing. You wanted to know, you said, John, how do you finish off this deal, though? Isn't that what you asked me? How do you finish off? Because your exact question was, okay, John, we went through, we did all the numbers here, but I want to know what my return is above and beyond cash. Right? Isn't that what you said?
Exactly.
Okay. And you'd like to see that done up here.
That's right.
Okay. So, let's do that. On this particular deal, let's figure total return on investment. Is that cool? All right. So, I wish these Elmers are great, but I wish they had like 3 or 4 cameras on these things. There's only one. Someone should invent that. They'd make quite a bit of money. Total return on investment. Is going to be this formula. Okay? CADs, or cash flow, plus appreciation, plus depreciation, plus amortization, divided by your initial investment. Now here's what I'd like to do, just for the sake of simplicity. If I bring Penny's deal back the way it was, okay? Penny, you're back. Welcome back, Penny. You have, okay. If I bring Penny's deal back, what you'll notice is the first time we ran this, we got a return of 18.4%, okay? And we ran the cash return on investment, which is cash flow divided by initial investment. Our initial investment was $185. And in running that cash return on investment, the 18.4 we decided was just outside of our target range, but we went for it anyway. And then what we did was we added leverage. We turned this deal from an 80-20 into an 80-10-10, and that increased our return to 29%. That's really, really good, okay? And, but we add leverage there, so our CADs went down. If we consider all of the other ways that we get paid in real estate, and we add the other things on that numerator of that equation, like appreciation, depreciation, and amortization, those two things, whether we figured it out at 80-20 or 80-10-10, that return is going to go up. Does everybody agree on that? Okay, so that's what we're expecting. So let's go back and just say that we stopped here at 18.4. You with me, Raphael?
Yes.
Okay, so at 18.4, Raphael wants to know if we did that deal just as it stands right here, how would we figure in the other 3 items? So I want to do, let's do a couple of scenarios where we're making assumptions. Let's say that we were able to raise rent a little bit and we increased the value of the property by 15 grand, okay? So we've got appreciation at $15,000, okay? So we've got our CADs. What's our CADs there? 34,112. Plus our appreciation of 15,000. And now we've got to figure our depreciation. Well, we're buying the property at 925,000. And usually with depreciation, when you're figuring it out, you have got to determine how much is going to be allocated towards the land cost, and how much is going to be allocated towards the improvement cost. The improvement cost, probably in Atlanta, is pretty close to about 80%. Now that's something that you want to check with your CPA or accountant on, but it's probably pretty close to 80%. 80% of 925 is what? 740? Okay. So if we took 740, actually I should be writing this neater here. Let's just put cash flow, just so that you guys can follow me, is 34,112. Appreciation is 15 grand. Depreciation, we're figuring out now. So 740, you said, right? So 740 is the number that we're going to be using and dividing by our schedule. So 740 divided by 27.5 is going to equal what? 26,909. That means that in our depreciation number that we use every year, we're going to be able to depreciate $26,000 of income, and that's going to go directly against our cash flow. Everybody see that? Mm-hmm. Okay, good. So, yeah.
When Lynn was in the other day, she addressed commercial as 39 years. Is that like factories?
Yes, factories and industrial and stuff like that. Apartments is going to be 27 and a half. Yep. She probably had residential up there, and that's the 27 and a half. Commercial would be industrial. Okay. So we've got the depreciation. Now we need to figure what? Amortization. So, by the way, I know Paul's using something over here. I'll just tell you what I use. It's $1.99. I don't have anything. Yours is free with a flaw. Let me see yours, by the way. Which one are you using?
Calc apps.
Calc apps? There's your whale sound.
Stay away from my web.
Let me, it's Calc apps?
Calc apps finance calculator.
Calc apps finance calculator. Yours is free. But the challenge I've found, this is the best one that I've found. I use something that says, it's called Calc Made Easy. It's on the iPad and iPhone. And when you're figuring deals like this, you not only have to use the calculator, but you've got to use the financial mortgage calculator as well. And you usually have to switch between the calculator. Calc Made Easy, you don't have to do that. It's all in the same app. That's why I like it. And it records everything you do.
It's $2.
It is $2, Paul. So it's called Calc Made Easy. I don't have anything to do with that company. It's just the one that I found that I like the best. You can email the results. You can add text to the results if you're working on a deal and you want it to specify it. So if I put in the amortization on my Calc Made Easy here, I just need to find it on my phone. Okay, it's right here. And I type in our loan amount. Now, since we stopped here, let's use the debt service for the year of 80% of 925, which is 740. And the loan terms of, hold on one second, 740. And the loan amortization of 25 years and the interest rate of 6%. We have a payment and all of that. We hit amortization. Maybe you can see that here. Can you see that? We hit amortization, and the first year we will have total principal paid of $13,172. So that would be our amortization. Did you see that, Raphael? I know that's hard to see. I almost want to like look under that camera. Can you see me under there? That would be so funny if I hid that somewhere, was able to come on screen. Are you guys understanding me? Are you? This would, hey, how about this thing? How about this for, please write this down, Yosh. This is my new invention. It's group dental work. What do you think? Anything? Any issues that you guys can see at all? Wait a minute. If I could just have that whale sound happen when I do that. Anyway, that's just how my mind works. Let's get out of there. So, where did I come up with this? What was our amortization? 12,000 what? 13,170. Okay, so If I go back to here, under amortization, we've got 13,170. Are you clear? 72, sorry. We're just going to go with the 70. Are we clear so far where we got these four? So what happens here is we take 34,112 plus 15,000. Now this is going to be skewed a little bit. I want you to get the overall theory. Plus 26,909 plus 13,170. And you're going to divide that by your initial investment, which was 185,000. And so if you add these up, Paul, 34, 15, 26,909, and 13,170, what is that?
89,191.
89,191 divided by 185, you get?
48.2.
48.2. So on this deal, our total return on investment is about 48.2. Now this may be skewed, it seems a little higher, but that's how you do it. Okay? Cool? Yeah. All right. Raphael's a question guy, so you gotta, Robert, I work to keep up with the questions. That's good. You know what that's called? That's called the Socratic method of learning. Socrates asked questions all the time, so it's a good way to learn.
Did you say you had a question?
Oh, no, no, no. So are we good on this? This takes practice. I would really work to practice this stuff. It takes time, I know, it takes time. Penny, do you want these notes, by the way? Okay.
Yeah, it's first year.
Based on 1 year. Could we go out 5 years, people? Yes, yes, we could. 10 years if we wanted to, but yes, it is. So Penny, I'll leave this up here for you. Okay? Yes?
That is an offset to the tax that we pay.
That is an offset. This goes against the cash. So you're not paying the taxes on that cash. You get the cash flow, you're not paying taxes on it. It is a way that we get paid in real estate that's non-cash.
Correct, but then should you not factor the tax you would pay on the cash flow? Because now you're adding a number that is going to help you deduct something. Am I missing something?
So what you're asking is, should you add to the performance of the property the taxes that you are paying on that cash flow that's left?
Not add it, remove it.
I'm not following you right now.
If your cash flow was, I don't remember the number, let's say it was $100,000 cash flow, and your tax rate for that was 20%, you'd have to pay $20,000 to the government in taxes, right? But then you would have a deduction on the depreciation side to bring back to this. Is that correct?
That's right.
So why are we adding it there and not taking the taxes into account?
Because that's total return on investment. That stuff, taxes, interest on all that stuff, that's figured out afterwards.
Okay.
That's figured out later. I see what your question is now.
Okay.
Yeah, with total return on investment, you just bring it to that point. When you turn in your books to your accountant and they do those taxes, they do all of that later. At the end of the day, if you wanted to come back then and say, okay, what's my true, detailed after taxes, earnings and all that after taxes, you could certainly do that.
But therefore, it would be slightly less than that number would be.
Probably.
Okay.
Probably because you're paying out taxes, sure.
Right. Okay.
Yeah. I try to keep this stuff as simple as I can on the teaching side. I want you to know there's more complexity that you could get into, but from a teaching standpoint, I have to really keep this on a even keel. I just want everybody to see that, okay? I know there's other things that we could go into, like 5-year annualized returns and, all the stuff after taxes. I understand that. I just really need to keep it simple so everybody can work this, okay? When we get this done, we'll do like an advanced class and go from there. Cool? Oh, did that make you mad? Yes. Hey, have a safe flight. All right. I'm sorry, what is that now?
The 15,000 appreciation it comes from.
The 15,000, I just made that up because we didn't have time to do that. I said, let's assume that we've increased the value by 15,000 bucks.
We did the water thing.
We did the water thing too, but yeah. So just assume it was 15,000.